It's a pleasure to welcome you all to the Federal Reserve Bank of Cleveland. And since my arrival in Cleveland over 2 years ago, I have seen firsthand the important role that the Greater Cleveland Partnership plays in supporting the growth of our regional economy, and I am very proud to serve on its board. Of course, as president of one of the country's 12 Federal Reserve banks, I have a keen interest in our regional economy. And as we gather in the lobby of this historic building, it's really hard not to think back to a time more than 100 years ago and applaud the congressmen, and yes, they were all men back then, who came up with such an ingenious design for our Federal Reserve System. Congress established the Fed in 1913 as a decentralized central bank, independent within the government, but not independent from the government. The Fed's design balances public sector and private sector interests and Wall Street and Main Street concerns. And I believe the design has served the country well by allowing monetary policy decisions to take into account the diversity of the American economy and its people. Now, as president of the Cleveland Fed, I make it a point to bring the economic information we've garnered from business, consumer, and labor contexts throughout the district to meetings of the Federal Open Market Committee, or FOMC. The FOMC is the body within the Fed that sets monetary policy. The insightful regional perspectives provided by our directors, advisory council members, and other regional contacts, along with the economic and financial data and analysis that we do, all play an important part in the Fed's setting of national monetary policy in pursuit of our statutory goals of maximum employment and price stability. I commend Chair Janet Yellen for fostering an atmosphere of serious deliberation and the free exchange of ideas in FOMC meetings. Setting monetary policy is a complex undertaking, and I believe the history of this institution has shown that better policy decisions are made when a diversity of information and views is considered. Now, some of that diversity was on display when the FOMC met last week and decided to maintain the policy rate at 1/4 to 0.5%. I, along with two of my colleagues, dissented from that consensus decision in favor of moving the federal funds rate up by 25 basis points. The reason I believe a gradual upward path of policy continues to be appropriate and that I favor taking another step on that path in September is because of the realized progress the economy has made on our monetary policy goals and my expectation of further progress. That expectation is based on my outlook for the economy. So today I would like to discuss my outlook for both the regional and national economy and my views on monetary policy. And of course, these are my own views and not necessarily those of the Federal Reserve System or my colleagues on the Federal Open Market Committee. The underlying fundamentals supporting the economic expansion remain sound. Household balance sheets have improved greatly since the recession, and households feel confident enough to be borrowing again. We've seen sustained progress in the labor market, and wages are gradually beginning to accelerate. Oil prices remain low, and while the decline in energy prices has been a considerable negative for the energy-producing sector, it's benefited households and the many businesses that consume energy. The underlying strength in the economy is demonstrated by the resiliency it has shown through a number of bumps along the road of expansion. Some of the recent bumps include the gyrations in financial markets at the beginning of the year, the slowdown in growth in China, economic weakness in Europe, the large appreciation of the value of the dollar between mid-2014 and the start of this year, and the uncertainty surrounding the United Kingdom's vote to leave the European Union. Now, all forecasts carry risk, and sometimes it's difficult to extract the signal about where the economy is headed from noisy economic and financial market data. With those usual caveats, my modal forecast is that over the next couple of years, the U.S. economy will expand at a pace at or slightly above its longer-run trend, which I estimate to be about 2%, that the unemployment rate will move further below its longer-run level, which I estimate to be about 5%, and that inflation will continue to gradually return to the Federal Reserve's 2% target. U.S. output growth in the first half of this year was quite low, coming in at only around 1%. Much of that sluggishness was due to a decline in business inventories, and so GDP growth underestimated the underlying strength in demand. Based on incoming data, growth is poised to rebound in the second half of the year. Consumer spending, which makes up about 2/3 of US output, has been a driver of growth, and I expect that to continue. Improving household balance sheets, growth in personal income, low borrowing rates, and low oil prices have all buoyed consumer spending. The housing sector is gradually improving, and I expect activity in this sector will continue to expand at a sustainable pace. The monthly home sale numbers have been volatile from month to month, reflecting a mixture of supply and demand factors. Builders have been telling us that they are having trouble finding qualified workers in some of the construction trades, and they're cautiously avoiding overbuilding, having learned from the housing boom and crash. Mortgage rates are low, but households are being careful not to take on more mortgage debt than they can handle, and banks are lending, but to those with good credit quality. In contrast to housing, business fixed investment remains weak, and this weakness is somewhat of a puzzle. Given the sharp drop in oil prices since mid-2014, it's not surprising that firms in the drilling and mining sector, their suppliers, at regions that are dependent on energy, were hurt. We've seen the effects in parts of the Cleveland Fed District where steel production, which supplies the energy industry, has been down, and other firms tied to energy have cut jobs and reduced investment. But even outside of the energy sector, business investment has been soft despite generally accommodative financial conditions. Manufacturing firms are telling us they are investing, but mainly to sustain current operations rather than to expand. Some of the softness in investment reflects weak demand outside of the US, which has hurt US exports. Other firms seem to be using the low interest rate environment to buy back stock rather than to expand plant and equipment spending. More generally, there just seems to be a sense of caution on the part of firms. I do expect investment to begin to pick up with economic growth, but the weakness in investment and the associated slow pace of productivity growth pose a risk for the longer run growth of the US economy. Structural productivity growth is a key determinant of the longer run growth of output and increases in living standards. And a key determinant of productivity growth is investment in physical and human capital. Labor productivity growth has risen at an annual rate of only 0.5% over the past 5 years. Part of this weakness is cyclical. Some of it reflects longer run demographics, including the aging of the population, and some of it likely reflects difficulties measuring productivity in the service sector, including intellectual property and information technology. It's difficult to forecast productivity growth, so the recent softness may reverse itself, or it may be longer lasting and reflect a structural issue. If it's the latter, then the longer run growth rate of the US economy may be lower than the 2% growth I've been assuming. Monetary policy cannot affect these longer term structural aspects of the economy, but it needs to consider them. For example, in an economy with low trend growth and productivity, the average level of interest rate that balances supply and demand, what economists call the neutral rate of interest, will be lower. But just because monetary policy can't move the trend growth rate higher doesn't mean there aren't other steps the country can take to address these longer run issues. Policies that encourage investments in technology and human capital, tax and regulatory changes, and longer run fiscal policy should all be under consideration. As this brief overview suggests, some parts of the US economy have fared better than others. But overall, economic growth has proven to be resilient, and I expect growth over the next 2 years to be at or slightly above a trend of around 2%. The pace of growth, while lower than in other expansions, has been sufficient to generate significant and sustained progress in labor markets. Since the trough in early 2010, the US labor market has added more than 14 million jobs, which is about 10% of employment. And the unemployment rate has fallen more than 5 percentage points from its peak of 10% in late 2009. The past 2 years have also seen significant improvements in other gauges of the underutilization of labor. such as measures tracking the number of part-time workers who would rather work full-time, and the number of people who have been discouraged from looking for a job. So far this year, firms have added over 1.4 million payroll jobs, an average of about 180,000 jobs per month. That's well above estimates of trend employment growth, which range from 75,000 to 120,000 per month. We're increasingly hearing from businesses across a broad set of industries that they are having trouble finding qualified workers, both in high-skilled occupations and in lower-skilled jobs. And we're now beginning to see firms respond by raising wages. I expect to see the labor market continue to tighten. Although payroll job growth is projected to slow a bit from the current pace, given the progress that's already been made, it will be sufficient to put further downward pressure on the unemployment rate. I expect the unemployment rate to stay below 5% over the next 2 years. I don't want to underestimate the difficulty that many people have had finding work during the recession and slow recovery, and that many continue to have, or the persistent differences in the unemployment situation faced by different demographic groups in the United States. Technological advances and globalization are changing the nature of available jobs and the skill sets needed to perform those jobs. I recently visited Hazard, Kentucky, a part of the Cleveland district in the heart of Appalachia. I spoke with some coal miners who were graduating from an electrical fiber optic lineman training program at the Hazard Community and Technical College. All 28 graduates had jobs lined up or were entertaining several job offers. Although this is just one program, it does demonstrate that progress can be made in addressing the longer-run workforce development issue our country faces. The Federal Reserve, through its community development function, has a role to play in easing such regional transitions. By objective analysis, we can help measure the scope of the problems communities in transition face, determine how best to scale up small, effective programs, and evaluate the pros and cons of alternative approaches and policies. Monetary policy has an important role to play in fostering conditions to ensure that the economy achieves an enduring economic expansion. This economic stability will help those demographic groups, minorities, older workers, lower income people, who are disproportionately harmed by economic downturns. But monetary policy cannot directly affect longer-run workforce development problems. And from the vantage point of our dual-mandated goals, I believe we are at maximum employment. The other part of the Fed's dual mandate is price stability. Inflation has been running below the Fed's target of 2% for quite a while, but it has picked up over the past year. I believe the conditions are in place for a gradual increase in inflation back to 2% over the next couple of years. The current low inflation rate partly reflects the effects of earlier declines in the price of oil and other commodities, as well as the appreciation of the dollar, which has held down import prices. As these effects have worked themselves through, headline PCE and CPI inflation, measured year over year, have moved up from the very low levels recorded last year to around 1% in recent months. To get a better sense of the underlying trend in inflation, economists often look at other measures of inflation that smooth through or strip out some of the more volatile components. These include core PCE inflation and trim mean PCE inflation, which are both at 1.6% and gradually nearing the 2% goal, as well as core CPI inflation and median CPI inflation, which are now over 2%. Indeed, the Cleveland Fed median CPI measure has been above 2.25% all year, and at or above 2.5% for the past 4 months. Stable long-run inflation expectations are an important component of inflation dynamics. Now, we look at a number of different indicators of inflation expectations. Some are based on surveys of consumers and of professional forecasters. Others are based on financial market data. The Cleveland Fed's expectations measure of 5-year inflation 5 years from now, which combines survey and market data, has been stable this year in a range of 1.75% to 2%. Reasonably stable long-run inflation expectations, evidence that inflation is moving up, continued strength in the labor market, and growth expected to be at or slightly above trend all suggest that inflation is on a path of gradually returning to our 2% goal over the next couple of years. Now, before I turn to the implications of the economic outlook for monetary policy, let me talk about our regional economy. You probably know the Cleveland district comprises all of Ohio, western Pennsylvania, eastern Kentucky, and the northern panhandle of West Virginia. Our regional economy is quite diverse, but the path of the economic expansion here and the outlook are similar to the nation's. To be sure, our region tends to be more dependent on manufacturing than other parts of the country. For example, manufacturing accounts for 15% of private sector jobs in Ohio compared to about 10% in the US as a whole. So the region has borne the brunt of the weakness in manufacturing. Similarly, the region has enjoyed the benefits of a sharp increase in production and employment in the oil and gas extraction sector as new technologies were brought to bear. But the sharp drop in oil prices since mid-2014 has resulted in a significant slowdown in natural gas and oil exploration in the Marcellus and Utica shale regions, which include northern Ohio and western Pennsylvania. The weakness in the energy sector is expected to persist somewhat longer, and the longer-term shift away from coal as a source of energy will have lasting effects on the coal-producing parts of the region that have not diversified their economies. On the other hand, the region has benefited from the strength in auto sales, construction, and the service sector, including health and education. We're seeing a modest pickup in regional manufacturing, particularly in firms that are more focused on domestic markets and the auto sector. The auto industry represents a significant share of manufacturing in Ohio and Kentucky, and over the past few years, district auto plants have produced about 17% of the nation's autos and light trucks. As auto sales have risen to record levels, regional production has risen as well. Our contacts in the district's auto sector remain optimistic, even though the record sales pace is leveling off. Housing markets in the region have shown improvement over time. During the housing boom, we didn't see the sharp increases in home prices experienced in other parts of the country, but we did suffer from the housing bust with a large number of foreclosures and vacant properties. The situation has improved. Residential real estate prices in Ohio are now increasing in the 3.5% to 4% range, with the usual variation across local markets. And according to the Cleveland Fed's Community Stabilization Index, communities across the 4th District experienced increased housing market stability in 2015, with mortgage delinquencies and foreclosure rates down. Residential builders tell us they are optimistic that regional housing markets will continue to strengthen. Like the nation, our region has seen considerable improvement in labor markets since the start of the recovery. In Ohio, the unemployment rate peaked at 11% in December 2009 and is now down to 4.7%. This is near the national average and quite a bit lower than the near 6% average Ohio experienced during the last expansion. Since the start of the recovery, Ohio has had a net gain of 500,000 jobs, and payrolls have now surpassed their previous peak by more than 1%. People have been re-entering the workforce, and over the past year, payroll employment has risen nearly 1.5% in Ohio, a net addition of 78,000 jobs. Job growth here is somewhat slower than the national pace of 1.75%, but we are doing considerably better than during the previous expansion, when employment in Ohio was essentially flat. This is all good news. But like the nation, the regional economy also faces longer-run challenges regarding investments in human and physical capital, as well as low levels of population growth and business formation. These challenges will need to be addressed if we are to remain a region with a healthy economy. So let me now turn to monetary policy by first laying some groundwork. The theory and practice of central banking provide several lessons for monetary policymakers. First, policymakers should be forward-looking because monetary policy affects the economy with long and variable lags. This means that policy actions need to be taken before our policy goals are fully met, based on the economic outlook over the median run and the risks around the outlook. Second, policymakers should strive to be consistent in how they respond to economic conditions and to effectively communicate the rationale for their decisions. This helps the public form expectations about the future path of policy and raises public confidence in the policy itself. Third, policymakers should always remain humble about what they know about the economy. and how monetary policy can affect it. There's uncertainty around the outlook, around the monetary policy transmission mechanism, and around underlying structural aspects of the economy, such as the longer run levels of the unemployment rate, trend output growth, structural productivity growth, and the equilibrium interest rate. Policymakers need to recognize that it is possible for the structure of the economy to change, but they should not throw out all that's been learned from past experience or be led astray by thinking this time is completely different. Now, as I mentioned earlier, last week the FOMC decided to keep the target range for the federal funds rate at 1/4 to 0.5%. In the committee's view, the case for an interest rate increase has strengthened, but it decided for the time being to wait for further evidence of continued progress towards the dual mandate objectives. According to the new projections, FOMC participants continue to anticipate that a gradual upward path of the policy rate will be appropriate over the next 3 years. But the consensus view was that it was better not to take the next step on that path in September. I and 2 of my FOMC colleagues dissented from that decision, preferring to see a 25 basis point increase in September. All participants on the FOMC share the same objective: setting monetary policy to promote our longer run goals of maximum employment and price stability, even if we disagree from time to time on the best way to achieve those goals. In my view, economic developments have corroborated the committee's median run outlook that labor markets will continue to show strength, that growth will rebound to a pace at or slightly above trend, and that inflation will gradually rise to our 2% target. We've seen sustained improvement in the labor market, which is now basically at full employment from the standpoint of what monetary policy can do, and inflation has moved up over the past year. The risks that concerned the committee, including the volatility in financial markets at the start of the year, economic weakness abroad, and the aftermath of the UK vote to leave the EU, have subsided, and the economic expansion has proved to be resilient. I view another small step on the gradual upward path as appropriate, not because I want to curtail the expansion, but because I believe gradually moving rates up as we continue to make progress on our goals will help prolong the expansion. It's also consistent with the policy communications we've been issuing for quite a while. I note that the gradual path I'm anticipating means that policy will remain accommodative for some time, continuing to lend support to the economic expansion going forward. The gradual path will allow us to recalibrate policy over time as we gain more insights into the underlying structural aspects of the post-crisis economy. Now, one can always say it's better to wait for more information before making a move, and a cautious approach has served us well so far during the expansion. But there are also risks to delaying for too long. If we continue to delay, even as we make further progress on our inflation goal and labor markets continue to tighten, we risk having to undertake a considerably steeper policy path later on. Such a strategy is inconsistent with what we've been communicating. It risks confusing the public about our policy rationale and undercutting the credibility of Fed communications. This would cause problems for future policymaking. In addition, if we delay too long and then find ourselves in a situation where the labor market becomes unsustainably tight, price pressures become excessive, and we have to move rates up steeply, we could risk a recession, a bad outcome that history tells us disproportionately harms the more vulnerable parts of our society. I think we also have to recognize that if we fail to exit gracefully from the non-traditional policy actions we took in the aftermath of the crisis, actions I thought were necessary and effective, we could jeopardize their use in the future should the need arise again. For these reasons, I favor taking the next step on the gradual path of rising interest rates. The lesson that policy should be forward-looking is based on the history of poor outcomes when that strategy hasn't been followed. In the face of evidence that the economy is on track to meet our goals over the median run, sometimes being prudent means moving the policy rate up. So 2 years ago, in one of my first media interviews after becoming president of the Cleveland Fed, I was asked where I saw myself on the avian spectrum. Would I be a dove who would tend to favor low interest rates, or a hawk who would tend to favor higher interest rates? My answer was that I'd prefer not to be thought of as either. Instead, my hope was to be viewed as an owl. Of course, that's not up to me to decide. Being thought of as an owl is my aspiration. But what I can do, and I'll continue to do, is explain to the public my view of economic conditions, the economic outlook, and the rationale for my policy decisions. I view this as an essential part of Fed communication so that the public can hold us accountable for our policy decisions. And I hope that you and our other regional contacts will continue to generously provide the Cleveland Fed with your perspectives on the regional economy. This regional information plays an important role in helping us to set national monetary policy in pursuit of the Federal Reserve's longer-run goals of price stability and maximum employment for the benefit of the public. I want to thank you all for coming today and for your attention, and I would like to take some, we have time for some questions. I'd be happy to answer them, or try to answer them. Thanks.
Doctor, thank you for your presentation. It was great. Can you expand on your comment about maximum employment and related to the 5% unemployment rate we have today, and also maybe translate that to northern Ohio?
Yeah, so when the Fed says maximum employment, right, it's basically what's the maximum we think is sustainable over the longer run. And a number of factors influence that over time. So it's not going to be necessarily stable over time. Right? In some cases, it's been lower. In some cases, higher. It depends on labor force participation. Right? Demographics affect that. The best evidence I've seen has it basically around 5%. Some people think it's a bit lower. Some people think it may be a bit higher. Some models that the Cleveland Fed staff maintain here that look at sort of flows into and out of employment have a bit higher. But 5% is about where I would expect it to be over the longer run now. And I think this is comparable for Ohio, with the demographics here are a little bit different, but basically. Of course, there's always error bands around those things, but we're not that different from other parts of the country in that respect. That doesn't mean that there aren't going to be pockets of markets where there's going to be higher or lower unemployment rates. It would be very unproductive if we sort of heat up the economy too much, send the unemployment rate down too far, right? That would cause, much more tightness in labor markets, right? And that would be, we'd have to then, perhaps raise interest rates to avoid too high inflation outcomes, and that could actually destabilize and risk a recession. So, there is another view of the world that says we should try to run the economy really hot to see if we can get unemployment down, but I don't think that's a very good strategy, right, for the economy going forward. I think it's a somewhat risky strategy, because whenever they've tried, policymakers have tried to do that in the past, it hasn't really produced very good outcomes. And so I think based on what I know about what we've learned from the past, and I do think that we should look to the past and some of our experiences, I wouldn't support that policy.
Thank you, Doctor. I was wondering if you might share some thoughts, or maybe a better question would be, the community right now is, through a voter referendum process, is looking at a minimum wage increase, at least within the city of Cleveland. I was wondering, has the Cleveland Fed or some of the other banks in the system looked at that issue from an analytical perspective, done any studies on what the impact might be on a regional economy or local economy with that type of strategy, that type of increase in a minimum wage?
Right. So we have a study that has looked at, whether raising minimum wages, what are the effects of a rise in the minimum wage. And economists, both an academic economist and policy economists and Federal Reserve economists have looked at those issues. And really, the evidence is very mixed. You can find some studies that would say it would actually improve things, and other studies. But the Cleveland Fed study, I think, points out that there can be unintended consequences, right? And it's going to have distributional impacts. In some areas, rising minimum wages, businesses will react by cutting employment, right, so they can handle the rise. In other areas, the minimum wage in the market is already higher, right, than the minimum wage that the law would put, and so that would impact it wouldn't have a very big impact at all. And so I think it's really mixed. One thing you have to worry about is, I come from Philadelphia. Philadelphia, for many years, had a high wage tax. And it affected if you worked in Philadelphia, but not if you lived in the suburbs, right? And then they changed it over time so that it was more inclusive, because what people did is they'd relocate outside of the city, right? So it can create a lot of distortions. I do think, though, it's incumbent on the country to think about, right, how to bring up low-income people so that we give them the skill set so they can rise up in the income distribution. So again, some studies would support rising the minimum wage. It's going to depend on the size that we're talking about, because if it's a small size, it may help people more than hurt. If it's very large, it could actually reduce employment.
Thank you. I and my firm concur with your recent decision to dissent from the rest and try to increase rates at this juncture, but maybe you could speak, you talk a lot about the value of history. History would seem to indicate that sometimes when the Fed puts something out, the value is when they meet that expectation. So there's been some things put out that maybe we've passed, and now you're ahead of the curve by wanting to move rates up and be consistent with what's been put out in the past. There's also the Greenspan days when a lot was held behind the curtain and no one had the transparency that they have today. Could you speak about the power of the Fed and how maybe the power would be influenced even more if you were able to meet these expectations and what you put out and actually deliver the rate increases in line with like what you're trying to do right now?
Yeah, so I think what we've learned is the credibility of the institution is very important in terms of the effectiveness of the policy. So in that sense, you want to have credible communication, right? You don't want to mislead the public. You want to be as careful as you can about not, you want the public to understand the rationale for your decisions, right? So economists would say, what's the reaction function of the Fed, Of course, writing down one reaction function doesn't capture the intricacies of actually having to do policy. But we do want to be able to be very systematic in how we react to economic conditions, right, so that the public can understand, right, where things are going, and they can form expectations. And the communications that the Fed puts out are a very important part of that, right? How do you let people know what kinds of things you're looking at so that they can form expectations? And the reason it's important is because nobody can foresee the future, right? So the economy is going to be hit by shocks, and it's going to send different statistics in different ways. If the public kind of understands, okay, I didn't know that was going to happen, but I know when that happens, the Fed's going to react this way, they can form expectations about policy going forward, and that helps them make better investment decisions and other kind of business decisions. So that consistency is very important because it helps people form their expectations about future policy. And I do have concerns that, we've been putting out for a long time that we believe a gradual path of increasing interest rates is appropriate. The latest projections that FOMC participants put out, if you look at the median path, it's an increasing path. I think the economic data and all the information that we've gathered from talking to people like you and other business contacts and consumer and labor market leaders is that we're continuing to make progress on our goals. And in that kind of environment, I thought it was appropriate to take the next step. And one of the reasons is I think we do have to be consistent with what we've been telling people we think is the right policy path. Now, the statement did say that they thought that the case for an increase had strengthened. It's just that they decided that this consensus was that September wasn't the time.
Price stability and full employment in some detail. Could you go into how asset prices figure into your calculations on setting monetary policy, real estate, stocks,
right,
bonds, et cetera?
So in two ways. One, you need, we knew this already, but we felt the brunt of it, right? You need to have stable financial stability in order to be able to achieve the monetary policy goals. So it's not a goal of monetary policy, but it's part of the environment, right? We want our bank regulatory function and our financial stability policies, both macroprudential and microprudential, are meant to make sure that we have a healthy banking system, right, which can support the expansion, right? So that's one way. And then we do look at asset prices, right, to be able to determine economic conditions going forward. So we routinely look at house prices, we routinely look at other financial market indicators because they do affect the growth rate going forward. So we don't target asset prices. We don't care, you know, if asset prices are one level or another. We use them as a signal for economic activity in the future. And same way with financial stability. We know that's a necessary condition, although not a sufficient condition, for having a healthy economy. And that's kind of how we approach it. We don't target them per se, but we use them as indicators of conditions in the economy going forward.
Yes, my name is Ken Taylor. I'm the owner of Ohio Cat. We're a Caterpillar dealer. And in this low interest rate environment in our industry, we've become much more capital intensive with assets, a lot of rental assets in our business today. When those interest rates start to tick up, I think companies like ours are gonna feel the pinch of interest expense rising and needing to consider pricing in the marketplace for our own products and services and rental rates, which is always tough in a competitive market. So just wondering, has the Fed looked at, as the rates do rise and companies have to face that environment after this long period of time with low interest rates, how is the economy going to adjust in that scenario?
So that's certainly something that when we're figuring out what we think is the appropriate monetary policy, we certainly take into account that there's going to be a response to interest rates, right? So we affect, right, investment decisions by the level of interest rates. But we also affect sort of other decisions in terms of sort of the pricing level in the economy. And so again, right, the kinds of interest rates that, if you look at the Fed overall participants are anticipating, and that I'm anticipating, are small incremental changes, right? So policy will still remain accommodative. We're not talking about making a non-accommodative monetary policy. We're just saying, let's take back some of the accommodation we put in place to address the crisis and early part of the recovery, right? So that we're calibrating over time to where the economy is going. And I think that's what we've learned over time, over history, is that that's appropriate. We need to be forward-looking. We have to think about where is the economy going, right? Taking into account what the data today is telling us where the economy is going. So we are, you know, the Fed has used this phrase data dependent, right? We're data dependent in the sense that the data kind of tells us about where the economy is headed, and then we try to calibrate our policy taking that into account. And certainly, right, in formulating our outlook, we do take into account the response from businesses and on consumers as well, on what's going to happen in housing markets. That's all part of developing that outlook.
Doctor, you talked about the unemployment rate as a good sign that the economy is bouncing back, and many people point to that at very low levels compared to what it was a half a dozen years ago. But there's also studies that show how many people have quit looking for jobs completely, and that many of the people who are back in the employment today are back at much lower paying jobs than they were before. And then you have that median income for middle income families going down or staying level. Is that really a good indicator now today, that because the unemployment is low, that really our economy is bouncing back?
Right. So we don't only look at one indicator of what's going on in the labor market and what's going on in income. So personal income levels are rising. There's evidence that wages are beginning, they've been stuck at 2% for a long time, they're beginning to accelerate. So again, we look at a number of different indicators. And you're right, if you looked early on in the recovery, some of those other kinds of underutilization of labor indicators, like, you know, how many people are just given up and out of the labor force, those hadn't come back. But if you look at them now, right, those have returned close to, if not exactly at, the pre-crisis level. So the movement is in a very good direction. And to my mind, given what I've heard from talking to business contacts like yourselves in terms of how difficult it is to find qualified workers, I think we're at a point now where the problems that are in some of the areas really are these long-run workforce development kinds of problems, making sure that people have the skill sets that are going to be in demand for the future jobs that are in our economy. So again, you know, it's an unfortunate, maximum employment is kind of an unfortunate way of phrasing our goal, because we do recognize that, not everyone, right, is back to where they were before the crisis. But overall, when you're thinking about setting the level of interest rates from the standpoint of what monetary policy can do, I would say we've met that goal. And now it's a question of making sure that we're setting policy to sustain the expansion. Because the worst case scenario would be we end up in a situation where we get back into another recession, and the very people that we're concerned about, right, the low-income people, the people who, don't have skill sets necessary to come back in, are going to be the ones hurt by the recession. So again, it's basically trying to calibrate to prolong the expansion, not to try to curtail it. Okay. Thank you.